Once a breakout setup has been identified, the next step is execution. Proper entry timing, risk management through stop-loss orders, and an awareness of market conditions can make the difference between a successful trade and a costly mistake. The most critical part of trading a breakout is knowing when to enter. Traders typically enter positions when the price breaks above resistance, indicating a bullish breakout, or drops below support, indicating a bearish breakout, with strong confirmation signals. A bullish breakout occurs when the price moves above a well-defined resistance level with increased volume. To confirm the breakout, traders often look for a strong candlestick close above resistance, rather than entering on the initial spike, which can be a false breakout. Additional confirmation indicators include a surge in trading volume, RSI moving above 50, showing increasing momentum, and a Bollinger Band expansion, indicating rising volatility. If a stock has been consolidating below a resistance level of $100 and breaks above it with high volume, a trader might enter at $101 to confirm that the breakout is real, rather than entering at exactly $100 and risking a false breakout. A bearish breakdown occurs when the price falls below a strong support level with volume confirmation. Traders enter short positions or buy put options once the breakdown is confirmed by a solid candle closing below support. Confirmation signals for a bearish breakout include high relative volume, RSI dropping below 50, indicating bearish momentum, and price breaking below the lower Bollinger Band. If a stock has a strong support level at $50 and breaks below it to $49.50 with increased selling pressure, a trader might enter a short position or buy put options to capitalize on the downward move. Some traders prefer to wait for a pullback to the breakout level, where previous resistance acts as new support in a bullish breakout, or previous support acts as new resistance in a bearish breakdown, before entering to get a better risk-reward ratio. Since breakouts are not always successful, using stop-loss orders is essential to protect capital from false breakouts and reversals. In case of a bullish breakout, set the stop-loss just below the breakout level or beneath the last swing low. A tight stop reduces risk but may lead to early exits on small pullbacks. A wider stop, for example using the ATR, average true range, allows room for natural price fluctuations while still protecting against major reversals. If entering at $101 after a breakout above $100, a trader might place a stop-loss at $98 or $99 to protect against a failed breakout. In case of a bearish breakout, place the stop-loss just above the breakdown level or the last swing high. Adjust stop levels based on market volatility to avoid being stopped out too early. If shorting at $49.50 after a breakdown below $50, a trader might place a stop-loss at $51 to account for possible retests. Timing is crucial when executing a breakout strategy. Breakouts that occur during high-volume trading periods, such as market open and close, tend to be more reliable. On the other hand, those during low-volume periods like midday are more prone to failure. First hour of trading from 9:30 a.m. to 10:30 a.m. Eastern Standard Time. The market is most active with strong momentum and volume from overnight catalysts. This is often the best time for breakouts as institutional traders and retail traders react to news. Last hour of trading from 3 p.m. to 4 p.m. Eastern Standard Time stocks tend to see an increase in volume as traders adjust their positions before the close. Breakouts occurring in this time frame can be strong but require careful monitoring. Lunchtime lull from 11:30 a.m. to 1:30 p.m. Eastern Standard Time trading volume significantly decreases as institutional traders step away. Breakouts that occur during this period are more likely to lack follow-through and fail. Price action tends to be choppy and range-bound. If a stock is setting up for a breakout, but the breakout happens during midday, it is often better to wait for confirmation in the afternoon session before entering. By waiting for confirmation before entering, placing well-calculated stop-loss orders, and avoiding low-volume periods, traders can improve their chances of capitalizing on strong price movements while protecting their capital. Once a breakout trade is executed, the work is far from over. Proper trade management is crucial to maximizing profits and minimizing losses. This involves monitoring price action for potential false breakouts, adjusting stop loss and take profit levels and maintaining discipline by sticking to the trading plan. Not all breakouts result in sustained price movements. Sometimes a stock may briefly move past a key level, only to reverse direction. This is known as a false breakout. Identifying signs of a false breakout early can help traders exit trades before taking significant losses. Lack of follow-through. If the breakout occurs but the price fails to gain momentum or struggles to move significantly beyond the breakout level, it may indicate a lack of buying or selling pressure. Low trading volume. A strong breakout should be accompanied by an increase in volume. If the volume remains low after the breakout, the move is less likely to sustain. Quick reversal back below the breakout level. If the price breaks above resistance but quickly falls back below it, it suggests that the breakout was not genuine and that sellers have regained control. Bearish candlestick formations like shooting stars doji or bearish engulfing candles near the breakout level may indicate weakness and an impending reversal. Exit quickly if key support or resistance is reclaimed. If the price moves back below resistance or above support in a breakdown without continuation, it's best to cut losses early. Re-enter only if new confirmation appears. Sometimes breakouts fail initially but succeed later. If volume picks up and price breaks out again, a re-entry may be considered. As a breakout trade moves in your favor, adjusting stop loss and take profit levels helps to lock in profits while reducing risk. A trailing stop loss moves up or down in the case of a short trade, as the trade progresses, helping traders capture more gains while still protecting against reversals. Methods for adjusting a stop loss. Fixed percentage rule. Move the stop loss 5 to 10% below the current price for long trades, or above for short trades. Moving average support. Use the 9-day or 20-day moving average as a dynamic stop loss level. If the price breaks below the moving average, exit the trade. ATR stop. Use the ATR indicator to set stops based on volatility. If the price moves 1.5 times ATR below the current price, exit the trade. If a stock breaks out from $100 to $110, instead of keeping the stop loss at $98, a trader might move it up to $105 to lock in gains while allowing the trade room to breathe. Previous resistance becomes the new target. If a stock breaks out above resistance at $50, the next resistance level, say $55, becomes the initial profit target. Measured move strategy. Estimate the expected breakout move based on the size of the previous price range. If a stock has been consolidating in a $5 range, the breakout target can be $5 above the breakout level. Scaling out of positions involves taking partial profits at key levels while keeping a portion of the trade open to capture extended moves. A trader might take 50% profit when the stock reaches the first target and let the remaining position run with a trailing stop loss. One of the biggest challenges in trading is controlling emotions. Sticking to a predefined trading plan helps prevent impulsive decisions that can lead to losses. If a breakout trade fails, do not immediately jump into another trade without proper confirmation. Only take setups that align with the entry criteria of the strategy. Aim for a minimum 2-to-1 risk-reward ratio, for example, risking $1 to make $2. Never widen a stop loss out of fear, stick to the predetermined risk levels. Losing trades are part of the process. Accept losses and move on to the next setup. Fear and greed often cause traders to exit too early or hold too long. Trust the plan instead. Keeping a trading journal helps traders learn from their mistakes and improve decision-making over time.